Welcome to the Deep Dive. Today, we're cracking open the latest results from Pidilite Industries Limited. That's the company behind Fevicol, Dr. Fixit, M-Seal, basically the go-to name for adhesives and construction chemicals in India.
Yeah, Pidilite's a really interesting one, kind of a bellwether, you could say. If you want a pulse check on India's construction scene, carpenters, even just household DIY stuff, their numbers tell a story.
Right, and we've gone through their Q2 and H1 FY26 releases that takes us up to September 30th, 2025. Our mission here is simple. Cut through the noise, find the really crucial strategic bits.
And the headline, well, it seems pretty clear. They managed double-digit underlying volume growth and revenue growth, which is quite something given they flagged a challenging macroeconomic environment, shows resilience.
Okay, let's definitely dig into that volume growth. UVG, underlying volume growth. That feels like the metric to really watch here, doesn't it?
Absolutely. It strips out pricing effects. It tells you how much stuff they actually sold.
Yeah, exactly. If revenue's up 5% but UVG is flat, they just hiked prices. Doesn't mean they sold more tubes of Fevicol.
Precisely. So looking at their main domestic business, the standalone numbers for Q2 FY26, net sales hit 3,272 crore. That's up 10.4% compared to last year.
And the UVG, was that the driver?
It really was. Underlying volume growth came in strong at 10.3%, very closely matched.
Huh, that's almost identical. And the profitability? EBIT.
Same story. Standalone EBITDA, that's earnings before interest, tax depreciation, landed at 807 crore, also up exactly 10.4%.
Wow, okay, so domestically things look tightly managed. Costs moving right in line with volume. What about the profit after tax, the PAT?
That followed pretty closely, too. Grew 8.1% to reach a 586 crore.
Yeah.
Solid performance on the core.
Okay, that's a standalone picture. But Pidilite operates globally, right? They have subsidiaries. How did the whole group, the consolidated entity, fare?
Right. The consolidated view is also healthy. Consolidated net sales grew 9.8%, hitting 3,540 crore. And consolidated EBITDA actually grew a bit faster, up 10.7% to 851 crore.
So slightly better profit conversion across the whole group compared to just the parent company.
Seems like it, yeah.
Just slightly. And looking back at the first half of the year, H1 FY26, did this trend hold? Was it stable?
It did, which points to consistency. For the full 6 months, consolidated net sales grew 10.2%, reaching 7,283 crore. And the real standout for the half year, I think, was the consolidated PT. That jumped 13.7% to 1,263 crore.
So that volume-led growth we saw is definitely hitting the bottom line over the longer period.
No doubt about it.
Okay, now this next bit I found really interesting. It's about their margins and strategy. Standalone gross margins improved by 47 basis points in Q2, consolidated by 67 BPs. Mostly because input costs, raw materials, were lower.
Yeah, they got some relief there. Raw material prices eased up a bit, which gave them a nice tailwind on the margin front.
But here's the kicker. They had lower costs, their margins improved, but they didn't just let that drop straight to profit, did they?
No, they didn't. And this is, I think, the core strategic point. They explicitly said that improved margin was deployed on ANSP. That's advertising and sales promotion. And GTM capability building. Go-to-market stuff.
So instead of just banking the extra cash, they plowed it back into marketing and strengthening their distribution network. That's a deliberate choice.
A very deliberate choice. It's an investment play. Betting on building the brand and reach for the long term rather than just boosting this quarter's profit figures.
That's gutsy, especially when things are supposedly challenging economically, investing more heavily.
It is. And what's quite remarkable is, even with that big step up in ANSP spending, which isn't cheap, they managed everything else so tightly that their standalone EBITDA percentage for Q2 was exactly the same as last year, 24.7%.
Wow. So they saved money on inputs, spent more on marketing, and still kept the overall profitability rate identical. That's some precise balancing.
It really is. Shows tight operational control alongside that aggressive investment.
Okay, so if they're pouring money into advertising and go-to-market, where are we seeing the results? Let's look at their main segments. Consumer and Bazaar, C&B, and then B2B.
Right. C&B is, the stuff most people think of. Fevicol for your local carpenter, Dr. Fixit waterproofing, M-Seal, craft supplies for students, the retail side.
And this is where you'd expect that ANST spend to hit first, right?
Absolutely. And it seems to be working. C&B revenue grew 10.8% in Q2, and the underlying volume growth was right there with it at 10.4%.
So strong volume performance in retail suggests the brand power is holding up, and maybe that investment is paying off already, at least domestically.
Looks that way. Then you have B2B business to business. This is more large-scale stuff, industrial adhesives, bulk chemicals for construction projects. Here, revenue grew 8.7%, and the UVG was slightly behind that at 9.9%. Still strong growth, but a bit different from CMB.
Okay, 8.7% revenue, 9.9% volume in B2B. What's the story behind those numbers? Any specific pushes or pulls?
It was definitely a bit of a mixed bag in B2B. On the plus side, domestically, things were good. They mentioned their project business, especially construction chemicals, maintained its growth momentum. So the building activity in India is helping them there.
Okay, that's the tailwind. What was the headwind then?
The headwind was external, global stuff. They specifically said B2B growth was partly impacted by lower exports of industrial products.
Ah, lower exports. And did they say why?
Yes, they pointed directly to higher tariffs. So trade policy changes, geopolitical issues impacting their ability to sell industrial goods abroad.
Right, so that external factor is making the B2B segment lean more heavily on the domestic construction side. Makes sense.
Exactly. And it also explains something else we saw. If you look at their subsidiaries, domestic subsidiaries grew nicely, 10.7% in Q2, but the international ones, much slower, only 4.5% growth.
Yeah, that fits the picture. Domestic strength carrying the load while international faces some headwinds, especially on the industrial side. Okay, shifting gears a bit from operations. There was a big corporate action this quarter that anyone following the stock needs to understand: the bonus issue.
Oh yeah, absolutely crucial context. Happened back in September 2025. Shareholders approved it. They issued over 500 million new shares. It was 1-for-1. So for every share you held, you got one extra bonus share.
Doubling the number of shares outstanding effectively. And important to note, this wasn't paid out of profits, right?
Correct. They funded it by using money from their securities premium account. It's more of an accounting adjustment, but it has a big impact.
What's the main implication for investors looking at the numbers?
The big one is earnings per share, EPS, because the share count doubled. The basic and diluted EPS figures for all the previous periods had to be restated, adjusted downwards to reflect that bonus issue.
Right, so you can't just compare the EPS number reported today with one from a year ago without making sure they're both adjusted for the bonus. Apples and oranges otherwise.
Exactly. Very important detail.
Okay, let's loop back to that strategic spending, the ANSP investment. How is that actually showing up in what they're doing? Are there new products, new campaigns?
Yeah, you can definitely see it. They seem to be getting much more targeted. Less one-size-fits-all.
Like that new professional FivicWick range.
Exactly. Different versions tailored for specific professional uses. That's segmentation, trying to get stickier with specific user groups.
And on the construction side,
New professional tile adhesive range apparently uses something called Techno-Adapt technology. Sounds fancy, but again, targeting specific pro needs.
and the actual marketing campaigns, are they doing anything innovative there?
Seems like it. They mentioned a FivicWick AI innovation campaign generated 840,000 user generations. Whatever that metric means precisely, it sounds like significant digital engagement.
So leaning into tech on the marketing side, but still doing traditional stuff too.
Oh, for sure. They got Dr. Fixit featured on Khan Banega Kropati, which is huge in India, and Fevical branding popped up on the Merrill Naka Aqua line in Mumbai.
Right, hitting both digital and very visible physical placements, covering the bases.
Definitely seems like a broad-based push, funded by those margin gains we talked about.
So given all this, the domestic strength, the investment, the export headwinds, what's the outlook from management? How are they seeing the near future?
Well, the managing director, Mr. Suhanshu Vats, sounded, I'd say, cautiously optimistic, especially about the domestic market.
What specific positives did he point to?
Okay, so good monsoons always helps rural demand, which matters for their C&B segment. Also, continued growth in construction helped by benign interest rates and enhanced liquidity. Basically, borrowing costs are reasonable for builders.
Makes sense. And you mentioned something about GST 2.0, indirect cascading impact. What's that about?
Right, GST 2.0. It's the ongoing evolution of India's goods and services tax. Generally, as it matures, it brings more businesses into the formal economy. For a big, organized player like Pidilite, that's usually good news. It levels the playing field, reduces competition from smaller, unorganized players, and can streamline demand.
Okay, so domestic tailwinds look decent, but he must have acknowledged the risks too, especially those export issues.
Oh, absolutely. He was clear on that. He stressed the need to be vigilant to geopolitical developments and specifically warned they could disrupt supply chains and create uncertainty around global tariffs. That directly echoes the B2B export challenge they already faced.
So the external risks are definitely still top of mind for them.
No question.
All right, one last area to touch on, which speaks to their longer-term thinking. Sustainability. They have some pretty ambitious goals set for 2030.
They really do. And these seem baked into their operations, not just grainwashing. They're targeting, from a 2019 baseline, a 70% cut in water use intensity, an 80% cut in Scope 1 and 2 greenhouse gas emission intensity, and aiming for over 70% renewable energy in their mix. Those are big numbers.
And they're actually making serious headway already, aren't they?
Remarkably so. The report mentioned that by FY25, so already passed, they'd hit a 74% reduction in energy use intensity and a 57% cut in water use intensity.
Wow, so they're well ahead of schedule on some of those key operational efficiency and environmental metrics.
Yeah, it suggests that focus on operational rigor is deep-seated, which, probably helps them manage costs so effectively elsewhere too.
Okay, so let's try and wrap this up. Summing up our deep dive on Pedialyte's Q2 and H1 FY26. It looks like a story of smart cost management getting benefits from lower input costs, but then making a bold strategic choice. Instead of just boosting profits, they reinvested those savings heavily into advertising, sales promotion, and go-to-market capabilities.
Right. And that investment seems to be fueling solid domestic volume growth, especially in their core consumer and bazaar segment. All this while navigating a major change in their share structure with that 1.1 bonus issue, and also dealing with very real headwinds on the export side of their B2B business due to global tariffs.
A complex picture, but the domestic engine seems strong.
Definitely. So maybe the provocative thought for you, the listener, to chew on is this. Pedialyte's betting heavily that deploying these margin gains into ANSP will drive consistent volume growth. The question is, how quickly will we see that investment translate into even faster underlying volume growth? And maybe more critically, can that domestic brand strength and investment fully insulate them if those geopolitical risks keep hammering their B2B export business? That's the tension to watch.
Brand resilience versus global headwinds, a fascinating balance. Okay, that's all the time we have for this deep dive. Thanks for joining us.
My pleasure. Always interesting to look at Pedialyte.